So what does it mean? 50 basis point cut, is this like really super good news for the market? So I think this week I will cover the topic of this monetary policy, US monetary policy, basically Fed cut, right? 50 basis point cut. I think that's quite a bit of surprise also because most investment banks, they actually predicted a 25 basis point cut. I myself also mentioned in the group, I think it will be a 25 basis point cut because just last meeting, they are not in rush to cut rate. Then suddenly once they started to cut, instead of doing a slow one, they straight away do a 50 basis point cut. So I think all this has been reflected in the market. I admitted that I was wrong on this one, but it doesn't really affect my decisions. It's more like just monitoring the market, see where's the monetary policy heading. But actually, I'm not like trading using this kind of indicators or this kind of development, right? It's more like just position our portfolio on a long-term basis. Now, let's go through the material. Then after that, I will come to the questions if there's any. Okay, so as mentioned, this is the headline, 50 basis point cut. So this is actually the first interest rate cut since the early COVID pandemic. US government, they are all doing everything that they can, including, like giving stimmy checks, everything. And then on the monetary policy, and also they really cut rate to zero and then pump the QE, everything. So these are really things that US Fed trying to do to save the markets during market crisis. But I think this round, this is not a crisis. It's just that there's moderating inflations. Hence, they just positions their monetary policy to stay in line with the economy. Because if you take a step back, basically they are trying to manage the economy. Essentially, is the employment. And then on the other side, which they are trying to tackle was the inflation. And later we will look at some of the charts to see that the progress that the US Fed has done on the inflation. This chart, I think, is also quite useful because sometimes when we look at the headline, we were like, 50 basis point, what does it mean, right? Not many people remember all these past historical changes in US monetary policy. I'll just tell some past history for those who are not monitoring market that closely, right? So this is the 50 basis point cut. You can see that 4.75 to 5%. This is the one that's announced. You can see that it's like a vertical drop, right? But if we take a step back and just rewind back to the last period when there's change of monetary policy, that was around 2023 when the US Fed, they realized that inflation is really running hot now. They have to jack up the rate. So they really jack up from close to 0% suddenly go up to 5%. Before the last rate cut, it was around 2020. That was a COVID pandemic. Before that, if we go back to the previous changes, that was actually around year 2017 to 2019 where the market is doing okay and then US Fed just hiked the rate. I think back then the message was that they are just trying to have some buffer just in case if they need to cut in the future. So they made the adjustment during 2017 to 2019 period now. So but that was a very gradual kind of move. It's like 20 basis point hike every meetings. And then if we go back, right, there's long period of time since 2009 until 2016 where the rate was essentially close to zero. That was the period after global financial crisis, which was a huge crash, right? And then even with all the QE, with all the stimulus, and still economy was still weak, and it has stayed so for quite a number of years. Basically from 2009 until 2016, still market economy, it was not doing well. We had this like long period of zero rate for long period of time now. And then if you go further back, right, you can see that, for example, from 2005 to 2006, right, you can see that there's still this interest rate hike, right? This is also to moderate the market as inflation was picking up, and that was the period before all the subprime crisis. So I think the takeaway, right, from this chart is that all these federal Fed fund rates or US monetary policy, right, they go in cycle one. There's a cycle down, and then you see like when they started to cut, right, it will be cut, and then when they know that the monetary policy, they need to tighten up, they want to control the inflations, they will just hike every meeting hike. So you see it's like a wave down, up, down, then up here. This is a small up. It's just that this COVID pandemic that create all these crises that they have to act very fast. So there's a reverse here, right, around 2020. And then we have experienced the hike in the past 2 years, and now it's just a start of interest rate cut cycle. So I think all this it's not like we are the only one that know about this. This is all, communicator and then the market, actually they will embed all this into their outlook. But the thing is that we still need to pay attention to this, right? Because you look at 4.75 to 5%, on the level still seems high, but I think what will happen is that we will continue to see rate cut moving forward over the next year or so. Okay, just to give you an idea, like the magnitude of cut, you can see that usually they are doing 25 basis point adjustment. It's just that 2022, when they know that they are behind the curve, they just have to hike a lot, right? So you can see that it was like between June 2022 to November 2022, it was 75 basis point every meeting. So that was a very steep increase, and that's also what caused the market drop quite a fair bit in 2022, right? For those who are new to this channel, you can always go back to the video that I made around end of 2022, where the market is all red, and then I look at my portfolio losing 100, 200,000, and then still doing sharing on YouTube here, just to give you an idea that whenever this kind of cut or rate hike, if they are done in a drastic manner, right? For example, in 2022, it was a huge increase, right? So it will have some impact to the markets. And now, because it is a 50 basis point cut, and we know that further cuts is coming, so I think that this is really bullish for the markets. But all this outlook, right, when it comes to, let's say, the one that we used to share a lot is the CME Fed Watch. That was actually the probability of further interest rate cut in the future. That was based on Fed Fund futures. That one is really, it can be very volatile. It's essentially this table. I'm sure you have seen this if you are in Telegram group, right, or on Twitter. People are sharing all this probability of upcoming cut, right? This is based on Fed Fund futures. It's like betting odds, okay? From betting odds translate to a probability. So there's a calculation behind. But if you want to look at some, like communications directly from the US Fed, right, which is like, they are Fed governors, they all have meetings, and then they discuss, they give their outlook on where's the Fed Fund futures rate end of this year, end of next year, and so on. So they have this dot plot. Each of these dot is actually one Fed governors, and then from this opinion, we kind of like just take the median and then see what's the expectation coming from US Fed. But this one cannot say that this will be right, because they are making their opinion on the outlook, right, also based on the current data. So as more and more data, like for example, inflation data, or the unemployment data, market data, economic indicators, all these things, as all these data surface, right, if the narrative change, if the data are pointing towards, for example, like a recession, so you will see a lot more cut. And if inflation's getting hotter again after they do like a 50 basis point or upcoming another 25 or 50 basis point cut, right? If inflation getting hot again, then they might need to slow down the cut in the future. So it's not a sure thing, but at least it provide indicators or some the opinions coming from the Fed, and we can take this as a reference. And because these tables, right, or this dot plot is not updated every day, so you basically can at least have something that is not changing very frequently, something that's more stable for you to take reference of. But that's also the negative thing about dot plot, is that it is not responding quickly to all the market indicators that just came up. I think this is something to look at. And if we look at this dot plot, right, actually they are suggesting that there will be another 50 basis point cut from today until end of the year. So I think there's three more meetings to go. But out of that 3 meetings, I think there will be another 50 basis point cut now. But if you look at the Fed Watch, CME Fed Watch, right, I think they are pricing a larger rate cut. If you look at the meeting date, right, say for example, this second row, right, this 18 December. So I think they are predicting like a 75 basis point from now until end of the year. Looking at different sources, sometimes the implied probability is somewhat different. By end of the year, whether it's 50 or 75, I think don't have to pay too much attention, because I think what will happen next year, right, is the ones that is even more important, because even if they have another 75 basis point cut, interest rate is still at like, let's call it like 4%-ish, right? So it's still high, but if you look at the outlook for next year, if really they are, progress as per indicated by this table here, right, then we will end up at close to around 3% by 2025. So I think that will be a monetary policy that I will consider very, very good for the markets because interest rate is low, financing is easy, and so on and so forth. So I think we should start watching for next year already, given that now it's already end of the year. This is coming from Charlie Bilello. So I think he said he has this chart, but essentially it's just you take all these different rate projection, right? And there's a probability here. Then you just weight by probability. You can see that this is the market expectations for Fed fund rate. So there will be a series of cut from now until around mid of next year. Then it should stabilize. But bear in mind that all these rates, right, it keep changing every day, every week one. So it might be different depending on the market indicators. And I think the reason why I got it wrong when I say I thought it would be a 25 basis point was because when looking at all this market data, right, I think one of the most important one will be inflation. And I think I missed this news that the inflation is already at 2.5%. I was still having this impression that inflation was around, let's call it like 2.9, 3.3% level. But the latest readings, right, which was I think the inflation for August, right, is right that it's quite a steep drop. Headline inflation was 2.5%. So you can see that headline inflation 2.5, and then Fed fund rate is at 5.25 to 5.5%. So it's a sizable difference between the Fed fund rate and also the inflations. So they can afford to cut. The core inflation also is like trending down currently at 3.2%, right? So I think what they try to do is that they still want to maintain a tight monetary policy, but not so tight to the extent that it should be close to 3% above the inflations. And I think that there's also more data that indicating that inflations is really moderating, meaning that it will head down to 2% rather than staying hot and can go back up significantly over the near futures. That's why I say 2.5%. As long as these numbers stay around this level, right, we should expect the rate cut. I mean, the outlook being priced in the markets, right, will materialize. So I think this is one key things that I think the market is watching for, which is the inflation rate. Okay, the next one I want to talk about the Fed balance sheets. So I mean, just take a step back, right? If you remember when the US Fed they cut the interest rate to 0%, right? It's still not enough because market was super weak. They really do the bazooka, really pump the balance sheets, really check up. Basically, they are doing quantitative easing. And by doing quantitative easings, they try to increase the M2, the money supply, by a lot so that the financing costs can really come down a lot. So that was the monetary policy during COVID period, right? So you can see that it really pumped from, about like 4 trillion up to all the way close to about 9 trillion. And then after that, they say that, okay, now because we need to tighten the monetary policy, we are just going to let Fed balance sheets to run down. But they don't want to use the quantitative easing as or the Fed balance sheets as a tool to manage the monetary policy. They still want to use the Fed fund rate. So what happened is that for balance sheets, right, they will just let it run off gradually as it matures. And so now these balance sheets, QE things already fade out. Actually, I haven't read about news about Fed balance sheets for quite a while already, and I haven't really paid attention to the progress of this balance sheet runoff. It's just that because we are talking about easing now, and you look at this Fed balance sheet is going down from 9 trillion slowly going down to now just slightly above 7 trillion. And I think Jerome Powell also mentioned that this balance sheet runoff, right, will continue. By continue, it means that actually the M2 supply will shrink according to the runoff, right? I think this will still be something that add towards the tightening part. That's why I think sometimes they do things, right, is on balance sheet end, is adding towards the tightening. So on the Fed fund futures, they actually lower down a little bit just to help up with the easing. So it kind of balance between these tools. But I think this is definitely a good sign where we don't have to pay too much attention to this. But I think for those who are waiting for market crash, right, please remember that in the past, let's say if we have some sort of recessions, right, I think the US Fed can still lowering the Fed fund futures by a lot. And then if still not enough, they still have this tool available, right, which is the quantitative easing. And this one definitely can help them, so-called save the market. So I think for those who invest in US market, right, let's say if you are the perma bear, right, you are waiting for market crash, you're waiting for 50-70% crash. Remember that there's always this tool around that can, mess up with your plan. I think that's something to pay attention to. Okay, now let's talk about the reaction, because I think people are paying attention to all this, right? So what does it mean? 50 basis point cut, is this right really super good news for the market? So this one, I take the screenshot of the day after. It's not the day of the announcement, it's the day after the announcement, where market sometimes they take some lag to digest the news, and then they decided that, oh, okay, monetary policy easing is coming, so let's buy stocks, right? So you can see that especially the tech companies, they appreciated in price quite a fair bit. I think this is definitely the effects, right, coming from the drop in interest rate. So I think which sector will benefit, right? I think the first one, which is shown on the chart here, definitely are the tech names, because we know that all these tech names, right, their profits is not now. Their profits, they still have growth forwards. So their cash flow is mostly those long term into the future. So if there's a lowering of interest rate, so all those stream of cash flow can be discounted at a lower rate, so they are worth more, right? So this is just the effect of change in the present value, basically coming from the interest rate cut. So this is definitely one. And then the other one, which is that the one that is directly affected by Fed cut, is actually if we look at the Singapore market, right, that will be the T-bill yield. So this one I extracted from the MS website. As you can see, the 6 months rate, right, I think it's not that obvious for now. I think since beginning of month it's like 3.13%, now it's down to 3.07%. I think as you observe this rate, right, this 3.07%, right, you observe this rate as we experience more cut by end of the year, for sure this 6 month T-bill will come down. For those who are rolling T-bill, please pay attention to this. If you think you need to make some adjustment to your portfolio, you have to do so, because the so-called high yield risk-free rate, right, especially for the short-term T-bill instruments, right, I'm not talking about the TLT or those long-dated bonds, right? I'm talking those who are investing in T-bills, or if you are investing in money market funds, please be prepared to see your yield come down. It will come down about the same magnitude as the US Fed. It's just that for Singapore, because essentially these are still different market, different currency, different market. So sometimes their correlation is not one-to-one, but still they have quite a strong correlations. Even the 30-year rate also, you see here, right, 2.86%, just within 3 weeks, right, also come down to 2.58% already. All this yield, they will at least, related, they will affect each other. And we all know that US is still the largest financial market in the world, right? So they will actually affect the risk-free rate of other country as well, so including Singapore. If you look at US Treasury yield, that will be a more direct impact. So you can see that this 1 month rate, right, early of the month is at 5.38%. This is close to the Fed fund rate, because the Fed fund rate was between 5.25 to 5.5. If you take average, it's about this 5.38%. So you see right after the cut, right, you already see that it's already down to 4.87%, which is close to 50 basis point, right? But the US longer end was still quite stable, around 4% right now. But I think the shorter end, right, which is 1 month, 2 months, 3 months, these will adjust very quickly, because they are all driven by the Fed fund rate. So it will drive the US Treasury yield directly. So I don't think many of you, I mean, as in those Singapore investor, right, I believe most of you don't invest directly in US Treasury bill. But let's say if you do, right, let's say if you have money market funds in US currency, just be aware of this. I think 4.87% still okay. It's still quite decent. The thing is that if you have money in money market funds, right, your reinvestment yield, meaning that the upcoming yield getting lower and lower and lower, and basically your future yield will come down. So if you count on this kind of returns to support your overall investment returns, just have the correct expectations, which is that you will come down. So I think this one is, I just try to look up from like the money market fund. This is from UBS. The currency is US currency, and you can see that the daily yield, right, is already down to 4.98%. So just want to let you know that for money market funds, because they are holding mostly those very short term, right, could be like 10, 20, 30 days kind of notes, right, or bills, right. So they will adjust very quickly. You can see that here is no longer 5.5%, is around 4.98% already. So if you monitor this one, upcoming cut, as we go through the further cuts, all this yield will come down now. Okay, the next one, let's talk about the good news, okay? Good news is that for those who invest in Singapore REITs, I think you will notice, right? The REITs has been rallying over the past, let's call it like 2 months or so. I know. We all, like discuss on Backholder Pod. People call us like, we are the REITs bear, right? Or always say that REITs are not good, only US is good, and so on and so forth. Yes, I remember we have said such things. I think maybe aside from Eric, I think the rest of us, we don't have a big REITs portfolio, right? Because let's say for myself, I don't invest like for you. I mainly invest like take care of the total returns of the portfolio, and my preference is always on US stocks, on all the tech names, right? So for REITs, I don't have a big portfolio on REITs, so I really miss out on these gains. But that's also because back then, right? Let's say just go back 2 or 3 months ago, I actually still have quite skeptics on whether US Fed will do this kind of like 50 basis point cut, and then all these things will materialize, right? Because remember that all these inflations, right? It is not like just, I mean, it has been there for a while, and I don't have idea how fast the inflation can come down, right? And also all these inflations is also because, you know, on US side they are doing a lot of fiscal spending, and all those things actually putting more oil onto the inflation fire. So I belong to the skeptics camp when it comes to inflation. That's why all this rate cut, right? You can say that this actually caught me a bit on surprise. So, but anyway, this one already happened, right? So it happened. Interest rate cut is coming. We all know this. If you need to change your view, change your view. And by that, lower inflations, lower interest rate for REITs definitely is a good news. And if you compare those large REITs versus the smaller REITs, right, I would say that for it's actually the smaller, less quality REITs, they will actually benefit more. The reason is very simple, because all these smaller REITs, right, actually they are, you know, they have debts that they need to refinance. And before the rates cut happen, right, if they have no choice, have to refinance, they actually pay quite a costly cost of financing, cost of debt. So they actually have to just take it, no choice. But now, because we know that all these interest rate will come down, right? Actually, that will lesser the burden, and then they basically can, you know, save quite a fair bit in terms of the cost of financing. And all this saving, right, means that there will be more money flows to the shareholders. So I think definitely good for REITs. You can already see that they have quite a sizable rally just over the past 2 months. I think that's congrats to all the REITs investor. I know quite a number of Singaporean investors actually, you know, very bullish on REITs, right? Because we have seen that REITs also went through this huge drawdown in the past, right? So now finally it's getting back. So really congrats. And then if you look at longer period, I think I show a few charts here just to tell you that, okay, let's say if you really want to invest for you want to get some dividends. The problem is that you look at this kind of chart, you are thinking that, it's already, you know, appreciated quite a fair bit from the low, right? And you wanted to wait, right? I would say that if you are waiting, I'm not saying that it won't come down. I'm just saying that if you wait for this, right, if all the rate cut continue to come, right, I think this one really, it is like this level around July. I believe this will be the floor or close to the bottoms of the REITs. I don't expect the REITs to reverse from now, just because interest rate is very favorable to Singapore REITs. So I think that's the takeaway from REITs. And some more, if you look at these charts, right, actually, if you draw a line from the current level to just, you know, just draw a parallel line here, right, you can see that actually you buy it here, you still consider getting a discount compared to period in 2021, 2022, or even some period of 2023. So actually, I would say that REITs valuations as of now, of course, not as good as 2 months ago, but still a decent one, especially for those who have like quite a sizable, let's say, short-term, all these money market funds, T-bills, right? I think you might want to, you know, put some money into REITs just to lock in for the longer dividend yields, because you are now, you know that the short rate, right, the 6-month T-bills, all these things, money market funds, all this will come down. Even all the high yield saving accounts, anything that you enjoy at this moment, right, probably in 6 months' time, right, it will be gone anyway. So maybe, you really need to position accordingly. Just now, the one that I shown, right, this is the IH Singapore REITs Index. So if you look at the compositions, right, if we compare, just like I said, the lower quality REITs, they may benefit more compared to the larger one. But let's say if I'm going to buy REITs, right, I'm not going to buy those lower rated one, because the lower rated one, small one, not quality one, sometimes you don't know what they are doing, you know. So it could be, you know, not managed well. There could be some problem with the balance sheets and so on and so forth. For me, let's say if if you are not paying a lot of attention, you are not reading their financial statements in detail, and you just want to get a dividend yield, right? I would say stay with the quality one so that you can sleep better at night, right? And the quality ones that they are shown in this page, these are the larger REITs, right? Coming from, it's a good mix of different type of REITs, like the CICT, Endowus, MIT Industrial and Logistics. I think these are good names. It's a good alternative, especially for those who have sizable T-bill that T-bill is coming down not too far in the future. Hi Buti, do you believe the US equities market will outperform the rest of the world as rates continue to fall? Another decade of excellence? In this one, I'm not sure. I actually don't think that given that the US cut rate, right, then US equities will outperform. I actually think that when US hike the interest rate, right, more money actually flow back to US. And as more money flow back to US, right, actually US, they are the beneficiary of this capital flow. And now it's the reverse, right? As they cut the rate, we all discuss about all this Japanese yen unwind, right? All these things, I think it will still come from time to time. So don't be surprised of that. And as more money flow out from US, right, I think this is actually not good for US. So let's say if you have a US portfolio, right, I think maybe your US stock portfolio, they are benefiting from the lower rate, but I think the one that will get hit is actually the US dollar. But US dollar versus US market, because we invest outside from US, right, at least there's some balancing between these two. At least our US portfolio go up and then US currency come down, they offset each other, right? So I'm not too concerned of my US portfolio. It's just that when it comes to asking like the relative US performance versus the rest of the world, I actually think that the world outside of US, right, say for example like emerging market, I think they will do better compared to US equities. Just judging from all this flow of capital. Can you also discuss these questions? How are you all dealing with interest cut? Looking to more value stocks, or how are you guys trying to find value in this market? Are you buying, stay in cash positions? So I think let me address the value part first, because for those who are new to this channel, I don't really call myself as a value investor, because it's not like I do all these intrinsic value calculations and then make sure that the price is, for example, like 30% below the intrinsic value, then only I buy. I actually don't do that. I buy companies that I think is quality companies, and then I understand the business model. I know that they are doing well, management quality, they have a good strategy. As long as the quality are good, right, sometimes I don't care too much about the valuations. Even valuations was pricey, I get a small positions, and then if the valuations suddenly become great, for example, like during end of 2022, so I add more into my positions in that scenario, right? So that's why I don't purposely look for value stocks, value companies. So that's just my style. Everyone have their own style. I think that's fine. You have your own strategy, right? There's no right or wrong answer there. I just want to address the value investing part, okay? And then on the second part, are you buying or stay in cash positions? I have to say, actually, I think I mentioned also, let's say early of the year, I say that I'm not investing as aggressively as, say for example, end of 2022. Back then, I really, like all in, and then even take a bit of leverage. That was my positions in 2022, right? Okay. I think since early this year, I already tried to, invest in a more prudent manner, meaning that I have some cash saving. First, I already paid off all the margins. I don't have margin in my account for quite a number of years already. And then I also save up for some money for cash emergency. And then last month, when I have T-bills and I actually know that all this Fed cut is coming, sooner or later they will come, right? So I just want to lock in like the Singapore saving bond positions. So I actually took the maturing T-bill and my monthly salary saving, right? I actually bought into Singapore saving bond for quite a sizable size. So I bought into that. I treat that as like just like a war chest. So that one aside. So I don't have much like liquid cash if you excluding all these Singapore saving bonds. But I still have some T-bills that's maturing in the upcoming months. So that one, as it matures, I might deploy some of them into the markets depending on the market, whether it's really like to like stay at current level or not. So I will deploy, but in terms of the selections, I think I will stay with the diversified ETF. I think that's because I don't see like a lot of like difference in opinion versus the market. Because for example, I think that Nvidia is good, but the market also like think it is super good, right? So the price is already there. So that's why I don't think that I want to position that far away from the say for example S&P 500. So in that case, just buy the S&P 500, right? Or just buy the ETF that I wanted to buy, right? So I think that worked well for me. Just that. Caveat wise, I don't have much liquidities. The liquidity that I have, I am comfortable with it. I'm just thinking that, let's say 2 years down the road, if I still have all this cash, right, and my mortgage, when it is up, right, I will just use the cash and just pay off my mortgage. I think that's also something that I plan to do. Is a matter of timing. So my mortgage is still about 2.5 years away. So I'm comfortable basically with any cash that I have. I don't want to save up too much cash from my current positions. So there will be more cash deployment from now on. Okay, that's address on that questions. See you in the next one. Bye bye.